morning to you. Welcome to Business Morning. I am Bisi Adebayo. Let's kick off today's program with the latest outlook from the International Monetary Fund, which has further slashed its projection for Nigeria's economy for 2020, with GDP expected to fall deeper by 5.4% from an earlier forecast of 3.4% contraction. The fund, in its World Economic Outlook update released on Wednesday, also expects South Africa's economy to shrink by 8% this year against the previous 5.8% forecast in April. At the same time, the IMF projects a deeper 3.2% drop in sub-Saharan Africa's gross domestic product, while it expects the global economy to contract by 4.9% this year due to the impact of the COVID-19 pandemic. Meanwhile, the Central Bank of Nigeria says it will not be discouraged from moving the country's economy away from a looming recession caused by the impacts of COVID-19. In a statement on Wednesday, the CBN mentioned that it had uncovered plans by some individuals to distract and discredit the financial regulators' efforts and circumvent the system through deliberate misinformation. The CBN further explains that it has curtailed the activities of smugglers and economic saboteurs through its collaboration with other relevant agencies of government and would continue to ensure a steady increase in the country's external reserves to protect the value of the naira among a basket of global currencies. And let's get more on this from the Director of Corporate Communications Department at the CBN, Mr. Isaac Okorafor. Good morning, Mr. Okorafor. Thanks for joining us on the program. So the CBN seems very confident despite the gloomy economic forecast. So the question is now, how exactly does the central bank intend to steer the country away from recession?
Well, thank you so very much for having me. Well, you have read out what the IMF has projected, minus 5.4. Initially, they said something like minus 2.4, and then saying that 2021 that we could do plus 3.5. On our side at the CBN, we believe that our projection, well, we feel at the end of the year we could make minus 1.5. And some people are actually saying is that if the price of the oil is maintains its level above $35, that we could do much better and even come out positive in the low positive area. But at the CBN, we have looked at it and we felt that everyone must work hard to ensure that the economy does not slip back into recession. And we have done that with a couple of interventions. We have the targeted credit facility for households and small businesses, which, as we speak, out of the 50 billion earmarked for this, more than 49 billion has been disbursed to over 80,000 families and households. We also have the 100 billion naira healthcare facility, which quite a number of operators in that area have benefited, and we are inviting others to come in. We believe that Nigerians have the power, have the energy, have the creativity to ensure that this economy doesn't go into recession. Of course, there is consensus that across the world that most economies, if not all, will go into recession this year, and Nigeria is not totally immune from it. But we are working as a monetary authority, as a public institution, to ensure that those Nigerians, families, and small businesses whose businesses were negatively impacted by this pandemic, that we give them the opportunity to work themselves out of that kind of recession and to be able to maintain even their businesses as they go on and their livelihoods. Small businesses that used to employ 2 or 3 people who account actually for much of the jobs in this country, that we want to ensure that they continue to do their businesses as if the pandemic did not affect them. And that is the only way we can make Nigerians work hard to ensure that the pandemic does not push us into a recession. Of course, there are smugglers, there are round trippers, there are those who are chronic takers in the banking system, there are those whose business is just to import any nonsense into this country, and forex speculators who see us as their enemies. And we are saying we work for the people of Nigeria. When Governor Emefiele took over in 2014, he said he would ensure that every policy from this bank, from the Central Bank of Nigeria, tries to influence positively the life of the ordinary Nigerian. And that is what we are doing. We have been trying to also fund manufacturing. There is the 1 trillion naira fund for manufacturers. And all these are aimed at ensuring that Nigerians, that productivity is enhanced and that we work our way out of the impact of this pandemic. That is all I can tell you. And we are not going to be distracted by all the things they say on social media about the integrity of the bank, about the person of the governor, Mr. Emefiele, and all that. We know they are stuck in thread. It's just to distract us, and we will not allow that to happen.
Thank you for those insights, Director, Corporate Communications Department at the Central Bank of Nigeria, Mr. Isaac Okorafor. Now, Nigeria no doubt has the potential to be a major supplier of petroleum products to other African countries, but experts say that would only be when the right policies are put in place. For them, Nigeria needs to move from selling crude to selling refined products. But joining me now to talk more about this is the Executive Secretary, Major Oil Marketers Association of Nigeria, Mr. Clement Isong. Good morning, Mr. Isong. Thanks for joining us on the program. So with the crash in crude oil prices and, of course, the volatility of the market, what is the state of the Nigerian downstream sector?
Good morning. Thank you for having me on the show. I think the downstream of the Nigerian oil industry has been impacted like the rest of the economy by the COVID epidemic. Remember that our industry, the downstream, was designated an essential service. So what this meant was that throughout the period of the lockdown, throughout the period of the challenges that we faced, our staff continued to work. From the vessels that were delivering products through the jetties, through the depots, the trucks, the filling stations. So we had to invest significantly in business continuity plans to make sure that our staff were safe. We had to adapt our procedures, our processes, our rules. We had to acquire PPE. For instance, normally we use breathalyzers before truck drivers are allowed to enter the depots with their trucks. But this time around, we had to change that. And instead of using breathalyzers because of the potential to cause a transmission, we had to change and use the simple walk a straight line test, for instance, in our depots. So we were heavily impacted in terms that we had to keep our business processes flowing. I think the biggest impact, I would say, for our businesses was the crash in prices. Very many of our dealers took heavy stop losses at the filling station. Remember that the price came down from 145 to 125. So it was extremely difficult for them. Not only did did they suffer significant losses during the period because of the lockdown. There were also low sales. So in spite of the fact that investments were made to keep the supply chain going, very many stations were selling 200, 300 liters per day. So it's been a very tough time for us. But we look to the future with hope. We look to the future with hope.
I know you say it's been a very tough time for you guys, but the issue of deregulating the downstream has been at the forefront recently. So tell us what's in it for your members, and with your experience outside the country, what do you think this would mean for the country as a whole?
Okay, you see, the challenge with price regulation, I keep trying to make the case for price deregulation and not deregulation of the industry. There are two separate things. What we are focused on is the removal of price controls. The regulation of the industry is absolutely necessary, especially when it comes to health, safety, the environment, and quality. It's extremely necessary. We commercialize extremely volatile products, and it is necessary that we do what is needed to provide, for instance, the truck explosions that you see, or the pipeline explosions that you see. Those are where we need very strict regulation. But we also need enough gross margin in order to ensure that regulations are kept, regulations are met. When it comes to price controls or price deregulation, we think it is good for the country. Price controls has created a situation in which we have paid, I think, subsidies over 10 trillion over the last 10, 12 years. This money could have been used to provide health care services. I think the COVID crisis has taught us that we really do need to do a lot of work to improve our healthcare services. It's the same with education. The security challenges that we face in the country, I think the only true solution to that is human development. We need to invest in our people. We need to invest in their education. We need to invest in jobs for them. And the subsidy causes us to simply just burn off in consumption instead of investing in our people. So in the first instance, for the country, removing price controls, removing price regulation will help the country to develop. When we talk about uncertainty and investments, in a world in which people are not certain of the prices that we sell their products, because prices are
All right, we'll reconnect with Mr. Clement Isong in just a moment. But let's just do a quick recap of some of the headlines we brought to you. Of course, we started with the latest outlook coming from the International Monetary Fund, which has further slashed its projection for Nigeria's economy for the year 2020, and the GDP is expected to fall deeper by 5.4% from an earlier forecast of 3.4% contraction. And the fund, in its World Economic Outlook updates, which was released on Wednesday, also expects South Africa's economy to shrink by 8% this year, and that's against the previous 5.8% that was forecast in April. At the same time, the IMF is projecting a deeper 3.2% drop in sub-Saharan Africa's GDP, while it expects the global economy to contract by 4.9% this year. Of course, that's due to the impact of the COVID-19 pandemic. Well, Mr. Clement Isong is back with us now to continue the conversation. Mr. Isong, you were talking about the need to deregulate the sector, but let me ask you, if actually deregulation is the way to go, why is the government still dragging its feet to do that? Although one explanation is that they wouldn't want marketers to exploit Nigerians, but is this applicable?
Well, I can understand that fear. But I guess it is simply two different philosophies. There are many who believe in the world that the most efficient way of ensuring is competition, in ensuring that there is no exploitation, is competition. There are those, of course, that believe in price controls. I think the world has moved towards competition. It is the most sustainable way of ensuring that the market is efficiently managed, is efficiently run. It is the most sustainable way of ensuring that the people are not exploited. In Nigeria today, we have had price controls for over 40 years. 40 years in Nigeria. Has it really worked? With 29,000 stations all over the country, and the amount of money that is spent on administering, trying to keep price controls in place, I don't think it is an effective way. It's expensive and it is ineffective. I think the rest of the world has decided that competition is the most sustainable way of ensuring that prices remain at its optimal level. At its optimal level. The problem with price control is that quite often the price point is below the correct price. And what that causes is that it is unsustainable. You find that, for instance, pipelines are not repaired in Nigeria. For instance, trucks, we are unable to renew our truck fleets. The infrastructure in the industry is degrading simply because we do not recover our costs and we do not make enough to continue to invest in the sector. So I do understand the fear. But where you have the regulator ensuring that there is no exploitation, that there is no price gang-up, this is what we expect a strong regulator to do. The Consumer Protection Agency of the country, this is what we expect them to do. So we can achieve both, avoid exploitation, but give the certainty that investors need in order to bring their investments into the country.
Now, the BPPRA had issued a statement saying that marketers are now free to import petroleum products. Are marketers actually importing now?
Well, I think we are much more or less where we have always been. It is the NNPC that is the major importer of petrol, premium motor spirit. For many reasons, we've always had the capacity or the ability the permit to import. The problem was always access to foreign exchange. And the problem was always the question of will you recover our costs when we import? I think we are still at that point. We still struggle to access foreign exchange. That is still a problem. But also there is the recovery. We are engaged with the PRA to try to ensure that we get a good number, that we agree on the cost of importation. If we do not agree on the cost of importation, then I'm afraid we shall continue to remain where we have been. It is important that we recover the cost when you import the product. It is also important that we recover our distribution costs. Those are discussions that are currently ongoing with the PPRA, and I'm hopeful that we will arrive at a just conclusion in the near future.
How will the planned Dangote refinery impact the sector?
Well, that's a very, very, very good project to be offering. We are looking forward to the Dangote refinery. A 650,000 barrel per day refinery will be extremely useful for us in this country. It will not only provide our country needs, it will also provide need for West Africa, for Central Africa. It gives us an opportunity to move from a net consumer of foreign exchange we will now start benefiting, because once we start beneficiating our crude oil, we're not just exporting crude, we're now exporting refined products. It would be extremely good for the country. We shall gain in terms of foreign exchange, AFTA, which is coming, that is the African free trade. It's an opportunity for Nigeria to take full advantage of its resources and to begin to export refined products. I think it's a fantastic opportunity, the Dangote refinery.
Executive Secretary, Major Oil Marketers Association of Nigeria, Mr. Clement Isong, thanks for sharing some of your time with us. Our commodities market updates will be up next when we return in just a moment. Please stay with us. Welcome. Welcome back, and it's time now for our commodities market update. And a research analyst at the financial derivatives company, Desola Sumoni, is ready to talk us through today's burning economic issues. Good morning, Desola. Well, the IMF has revised downwards its global growth forecast to minus 4.9% from its earlier forecast of minus 3% in April, and of course further slashed its projection for Nigeria's economy for 2020, of course, with the GDP now expected to fall deeper by 5.4%. What's the implication of all of this?
So that the implication of this slash in projections are diverse. One, it means that the impact of the lockdown, what the IMF calls the Great Lockdown, was deeper. The negative impact of it was deeper than we expected. It also shows that the recovery, the economic recovery, is going to be slower than expected. It's not going to be the V-shaped recovery that some people are touting. It's going to be more of a U-shaped recovery. And for economies like Nigeria, where the rates of infections are still rising, it means that there's going to be a slowdown in economic activity. It means that there's going to be a slowdown in economic activity. So also, the World Bank has forecasted that this pandemic is going to push 23 million people in sub-Saharan Africa into poverty. In Nigeria, that figure is 5 million. So it means that more people are going to be poorer as a result of this pandemic. And also in countries, in key economies like China, like the United States, where the rates of infection are still increasing, it means that the expected recovery in demand for oil will be slower than expected. And Nigeria depends heavily on oil. So that also has a knock-on effect on Nigeria's recovery. But it's not all gloom and doom. Yesterday, the President and the Federal Executive Council approved the National Economic Sustainability Plan, which is essentially a plan to prevent Nigeria from slipping into a very deep recession. The plan has three main objectives. One is to address the FX crisis. Two is to reduce youth unemployment, which the reports from the plan projects to reach 33.6% by December 2020, against the last figure we had for Q3 2018, which was about 22%. And finally, the plan aims to reduce the negative impact reduce the impact on economic growth.
Now, the naira has depreciated to 460 to the dollar at the parallel markets. At the same time, we've seen external reserves decline by 2.7% since May. What are your thoughts on these developments, even as the CBN seeks to unify the exchange rates at the I&E window?
Well, first, I'll say it's about time. My colleague, Mr. Bismarck Rewani, has been talking about the need to unify the exchange rate for a while now. Other economists have also been talking about it, the IMF, the World Bank. In fact, recently, as part of, in the reports where the IMF approved Nigeria's request for 3.4 billion naira in dollars, I beg your pardon, in financing, the IMF reiterated the need for Nigeria to achieve, to unify its exchange rate. Currently, as you know, we have multiple exchange rates. Three come off the top of my head. One, we have the interbank exchange rate, which is about 360 naira to the dollar. We have the investors and exporters window, which is about 386 naira to the dollar. And we also have the parallel market, which is about 460 naira to the dollar. So unifying this, I think, for one, is going to help increase the naira equivalent of our FAC disbursements, which is going to be positive for economy, so cash trapped at this time. Also, it's going to reduce distortions in the market. Currently, we have a lot of, even though we have a lot of round tripping going on. Finally, it's going to boost investors' confidence, which is going to increase inflows of FX into the country. Now, the central bank governor has spoken about, the exchange rate being unified around the I&E window of about 386 naira to the dollar. But analysts have reviewed that is not the real effective exchange rate, that is still overvalued, that the real effective exchange rate is around 400 to 410 naira to the dollar.
But what would be the impact of unified exchange rates on the commodities markets? Won't it lead to a hike in prices of items?
So to unify this exchange rate, we need about a 15 to 20% devaluation of the naira at the official market. So what does this mean? First of all, looking at the domestic commodities market, we have commodities that are import dependent, and we have commodities that are not import dependent. For commodities that are import dependent like wheat, like flour, we expect a knock-on effect of the devaluation on commodities prices. For instance, the bag of a 50 kg bag of the price of a 50 kg bag of flour is about 12,700 naira. We expect that if we expect a 15 to 10% devaluation should increase the price of that bag by about 10%. So from 12,700 to about 13,900. And this is going to have knock-on effects on commodities that depend on flour, that depend on wheat, commodities such as bread, like Indomie noodles, like noodles, I beg your pardon, like pasta. And that's going to increase the prices. But as the price increases, the demand is going to reduce, and we are going to see a shift to substitutes such as yam, such as beans, such as guys. So as we see demand for substitutes increase, we expect the price for those substitutes to also increase. So overall, we expect this a potential expected devaluation to push domestic commodities prices higher. However, we are not sure about when the potential devaluation or when the currency adjustment will take place. I mean, this is not the first time the central bank has hinted towards a currency adjustment, but we are hopeful that this time there's more commitment by the central bank. But again, this is going to have a knock-on effect on food inflation, which is currently at 15%. We expect it to also increase further in the near term.
Now, let's talk about the crude oil markets. Now, of course, it's been very volatile lately. And as at this morning, Brent crude is down to about $39 per barrel. Where do you see oil prices in the near term? And tell us, what will be the implications of a lower price environment for Nigeria?
Like you said, oil prices have been volatile this week, and it's not far-fetched. The key reason is the impact of the coronavirus pandemic. But more recently, we are seeing a huge build-up in crude stockpiles. For instance, data from the American Petroleum Institute and data from the Energy Information Administration shows sharp increases in crude stockpiles. For the API saw an increase of about 1.7 million barrels in crude stockpiles last week against expectations of about 200,000 barrels. Same thing with the Energy Information Administration. They saw an increase of about I think 1.5 million against expectations of a build-up of about 100,000 barrels. So that's the sharp increase in crude stockpiles signals that the storage capacities may be maxing out. Also, we are seeing increase in production from the United States. I mean, data again from the Energy Information Administration shows that U.S. production for last week was about 11 million barrels per day compared to 10.5 million barrels per day the week before. Furthermore, we are seeing spike in coronavirus cases in the United States. We are seeing sharp increases coming from Florida, coming from California, coming from Arizona. So all these factors simply point to the fact that we are going to be in this low price environment for a long time. Now, what does it imply for Nigeria? Well, for Nigeria, again, it implies lower exports revenue. It implies lower government revenue, lower FAC to be disbursed to the three tiers of government, which is critical for us now at this time because of the impact of the coronavirus pandemic. So there's a need to shift to IGR, to shift to other source of non-oil revenue, which the government is already doing. But the slowdown in economic activity due to the coronavirus is also going to reduce the amount of tax revenue that the government can collect.
And still talking about the impacts of the COVID-19 pandemic. Now, we've seen many African economies increase borrowing significantly to respond to the pandemic, while also asking for debt relief on the other hand. Of course, the federal government recently announced that Nigeria is no longer seeking debt service moratorium. But what are your thoughts on this development?
Yeah, it's interesting that a lot of emerging market economies are, what's the word now? They are borrowing more from the international bond market, or international capital markets, rather than restructuring their current borrowings to finance their debt. In fact, data from Institute of International Finance show that since April up until now, that emerging market economies have raised about $83 billion from international capital markets. So the question is, why are they raising their money? Well, why are they raising such money? Why? Sorry. In addition to that, I beg your pardon. In addition to that, like you said, the G20 has granted debt relief, but a lot of data is showing that uptake is very low. Of all the countries that are eligible to take this debt relief, only about 50% have applied, and of those that have applied, at least in the last 8 weeks, only about 7 have been approved. So why are these countries not applying? Well, the reason is simple. They are not applying because of private investors are similar to Nigeria. Private investors are going to see taking debt relief as a sign of default, and which is going to affect the ability of these countries to borrow in the capital markets going forward. So, which is going to affect. So for Nigeria said, you know what, we're not taking debt moratorium because Nigeria already initially planned to borrow about 3.3 billion from the international capital market, and then coronavirus hit. So taking this debt moratorium would reduce Nigeria's ability to borrow, to access the international capital market, and also Nigeria as well as other African countries are going to need to access capital markets after the coronavirus pandemic passes to facilitate their recovery, because the economic activity is going to be so low, and we will not be able to depend on internally generated revenue alone, or even oil revenue.
Now, let's talk about power now, Desola. What are your thoughts on the introduction of cost-reflective electricity tariffs, which are expected to come into effect next month?
I think, first of all, it is positive. The introduction of this cost-reflective tariff was supposed to take place in April, but was postponed because of the coronavirus pandemic, and now it's going to take place next month. I think it's positive. I think it's about time, because the power sector, technically on face value, has been privatized, but there's still a lot of subsidy. There's still a lot of subsidy because of there's still a lot of subsidy. So, and the distribution companies were complaining that, you know, the price they are charging customers was too low for their business, and it was affecting their top line and their bottom line significantly. So what happens is that when the generating company generates power, the distribution company don't take a lot of power, and that is why they are not able to distribute to the end users. Also, the World Bank has approved a $750 million loan, I think yesterday, to the power sector of Nigeria, so that the power sector, particularly the generating and distribution companies, can become more financially viable, and also so that they can embark on capital projects to increase access to grid access to electricity. So overall, I think it's positive. I mean, there was an experiment in the Magodo area of Lagos recently, where they adopted a cost-reflective tariff, and they enjoyed almost 24 hours of constant electricity supply. So I think it is a positive development, in the sense that, yes, on one hand, prices, the tariffs, your electricity bills are going to increase. But on the other hand, you are going to enjoy more electricity, which is going to improve productivity. And overall, I think it's going to have a knock-on positive effect on economic growth.
Which is what everybody is looking forward to. Research analyst at the FDC, Desola Sumoni, thanks for speaking with us.
Thank you for having me.
Welcome back. I guess I was pretty much excited that Temple Ashaju is actually back with us to run us through the market activities. Welcome back, Temple. We actually do miss you. And it even looks like the market missed you as well, because these are certainly not happy times at the market.
Absolutely. That's because we've been seeing a lot of risk-off sentiment in the market. A lot of investors are not happy with what is going on in the global stage. We've been hearing negative news everywhere. So what you want to do at this point is to hold on to what you can get in terms of profit. Better still, just save your cash. That's exactly what we're saying. And the market here, equity space on its own, it's not actually it's not alone in that regard. Yes, basically yesterday we were down some 0.38%. This is it. That reduces our all-share index from close to 25,000 where we were before. And look at the equity capitalization is now dropped all the way from 13 trillion naira to just 12.861 trillion naira. But we do hope that things will change today, because lately we've seen a lot of losses, and we know that we've seen a lot of portfolio rebalancing in the markets as well in recent times. But look at the activity level yesterday: 189 million units of shares traded for a value of 1.91 billion. This is really low compared to what we do on daily basis before now. The deals yesterday was 3,364. And let's look at the sectoral performance. The banking stocks managed to put up some 0.24% gains. Of course, a couple of mid-cap stocks there, and of course some smaller cap stocks actually pushed up the performance of this segment yesterday. Look at the consumer goods side of the market. PZ contributed massively to what we saw here. And of course, International Breweries. This is a company that a lot of investors actually purchased at around 30 naira, 26, 29 naira. You know, but it settled at 30 naira for so long a time. But now we're saying it doing less than 10 naira. This is not so impressive for a lot of investors. But what you can do is just to continue to hold on. Let's hope for better days. Industrial goods side of the markets, your regular Boa cement that has been pushing up this side of the market lately is now calm. Investors are waiting and watching, sitting on the fence, hoping for better news to come and help them to come and bet on other stocks. Insurance segment of the market, this is one very tricky side of the market. This is actually positive, up some 0.87% yesterday. Look at oil and gas. Seplat weighed down this sector yesterday in terms of performance. And if you look at what we have, losers, PZ, Seplat, and International Breweries. And of course, the gainers are just Champs, Champion Breweries, and of course, Unity Bank. But we have Mr. David Adonri, who's a stockbroker with High Cap Securities, joining us this morning. Mr. Adonri, good morning. Thank you for joining us on the program.
It's a pleasure, Temple. Thank you.
So how much of opportunity do we have for bargain hunting today, given the losses that we've seen in recent sessions?
Yeah, I think the market is trying to step up a little bit. In recent times, the volume has been increasing together with the value, indicating that bargain hunting is also gradually declining. So the market is getting much more better and encouraging now.
So for today, what will be your picks in the market?
I think the firming up is likely to increase because the situation in the petroleum market is also getting better. And the market moves in the same direction with the changes in the crude oil market.
Okay, so let's hope that at least will help us to change the paradigm again for the markets today and see the all-share index gaining, facing the northward territory for the market today. Thank you so much, Mr. David Adonri, trader with High Cap Securities. I appreciate your insight. Back to you, BC.
Let's just pray that our hopes won't be dashed again at the end of today's trading. Stick around, hopefully. Temple. We'll come back to you in just a moment. Plus, we'll do a crossover to our London studio. Please stay with us. Let's head now to London, where Juliana Olayinka is waiting to bring us this morning's business headlines. Good morning, Juliana. Labour has warned Rishi Sunak that the Treasury's one-size-fits-all approach to ending wage subsidies risks a period of mass unemployment that will reverse much of the good that was done by the furlough. What exactly do they want Sunak to do?
Good morning, Bissy. Well, you know, by and large, the Labour Party here in Britain have pretty much supported the government's furlough scheme and the subsidy scheme and all the other schemes that they've been rolling out to try and help the country and the economy survive the coronavirus pandemic lockdown. But now that lockdown is beginning to ease and we're really starting to see what the fallout of this lockdown could mean, there are growing concerns about mass unemployment. So Annalise Dodds, she is the Shadow Chancellor of the Exchequer. She was writing in The Guardian this morning, and she basically was urging Chancellor Rishi Sunak to try and stop this one-size-cookie-cutter fits-all policy, particularly when it comes to the furlough scheme, which we know so far has paid up to £2,500 for individuals who are on that scheme. In August, it will be tapered off. I believe it will be about 60%. And then in October, it will no longer exist. And she's really concerned about this because all of the data that we have been getting from the Office for National Statistics and from business lobby groups do suggest that once employers are asked to start contributing to these wages, there will be mass redundancies, as we've seen across the airline industry. So she is asking for that. I believe there was some data from the Treasury last week which shows that 9.2 million individuals are being paid under that furlough scheme. We know that July the 4th, the hospitality sector will finally be open, but not everybody, Bissy, will be able to open those doors. So that's what Annalise Dodds is asking Rishi Sunak to do, which basically means that she wants the government to support particular sectors that will be hit the most and ask them perhaps not to contribute to their employers' wages so soon, just to see how the economy can start ticking again.
Britain's largest steel maker, Tata Steel, is awaiting a government decision on a possible rescue deal that would save 8,000 jobs in a struggling sector whose problems have been compounded by the coronavirus lockdown. How much is Tata Steel hoping to get from government support?
Well, hundreds of millions of pounds. That's what the Financial Times have been reporting over the past 24 hours. And it's actually under a coronavirus scheme. It's called the Project Birch scheme, which we haven't really spoke about a lot on this programme. This is another scheme on top of the three schemes that the government already have. And this one is really to help large firms who haven't been able to benefit from any other of the government measures. Tata Steel, as you said, they faced issues over the past couple of years. They did quite recently get a bailout from an Indian firm. So it is owned by an Indian firm, even though it is historically a British steel company. So we're expecting within the next couple of days that they will reach a rescue deal with the British government to the tune of £500 million. And apparently there is some sort of repayment offer going out. So if they are unable to pay, then the British government will transfer that loan to equity. So for the first time in 30 years, the British government will have a piece of a British steel company. Perhaps that's their aim. So yes, this is apparently going to be done over the next couple of days. And should it be successful, then 8,000 jobs will be saved.
Now, what about Royal Mail, which has just announced plans to cut 2,000 management jobs, which is about a fifth of its managers, as it struggles to deal with the effects of the coronavirus crisis? How's the market reacting to this?
Well, as soon as they made that announcement this morning in early trading, their shares were down 4%. And it's really been a tough period for Royal Mail, like it's been for many companies, but particularly them, because, of course, their bread and butter has always been letters and posting letters. We know that most people haven't been posting letters. Most people now, resort to email, don't they? And so they've tried to transition into being a parcel delivery service, but it's difficult to compete with the likes of Amazon. So this morning, they announced that their year-to-end profits were down by 13.6%, and then they did announce that they will be cutting those 2,000 managerial positions, which they believe, or they hope, that over the next 2 years will save them over £300 million. Their former chief executive did quit as well just a couple of months ago, as staff were not happy that he was living it up in one of his nice properties in Switzerland. Now, Keith William, he's their interim executive chairman, and he said in recent years our UK business has not adapted quickly enough to the changes in our marketplace of more parcels and fewer letters. COVID-19 has accelerated those trends, presenting additional challenges. So as well as those losses, they said that if the reports are to be true and that UK GDP would contract by as much as 15% this year, then that means that they could lose £600 million. So not a great day, and the shareholders clearly were not happy with those announcements.
Certainly not a great day for them. Thank you, Juliana. We'll see you at 1:30. And it's right back to Temple for a review of the debt and currencies market. Temple.
Sure. Thank you so much, BC. I mean, let's look at the bond side of the market yesterday, where we got a bit of interest. So much of profits taken at this end of the market yesterday. Investors looked at the longer end of the curve. Look at the 2049 paper here. A bit of profits taken there. And of course, look at the 2025, which is at the mid end of things. If we put all that together, we had some 52 deals in total for a value of 113.24 billion naira. Now moving out to the NTB side of the market, where we saw a little bit of offers, but not so much of of activities eventually, because as you know, this side of the market has been recording so much of retail participation lately. Investors looked at the 10th of June 2021 security, and that's how we came about the 760 million naira worth of transactions on this particular security. In total, we had 12 deals for a value of all less than R1 billion eventually. But let's move on to the open market operations maturities. Here we noticed yesterday that investors, especially the offshore investors, they came in more with interest on the September paper as well as the December paper, and of course there was an August paper as well that indicated interest in. At the end of the day, we got offers between 3.8% and 4.6%. At the end of the day, these were the key areas where investors channeled more interest. Here we saw some profits taken at the end of the day. And of course, deals was 32 for yesterday alone. 33.81 billion naira was what it all settled at yesterday. But we have Adekemi Adenuga, an FX trader with FSDH Merchant Bank, joining us on phone now. Let's talk about FX. Adekemi, thank you for joining us on the program this morning.
Thank you, Temple.
Great.
Good morning.
So yesterday we saw some $90 million plus crossing at the investors and exporter window. Is this some kind of a silver lining for us? Because we know that lately we've not been seeing this much volume of transaction at the I&E window.
Yes, Temple. Yesterday's figures were an improvement to what we have seen in the market, and hopefully we'll begin to see such improvement in the market. This is clearly unconnected with the fact that economies are beginning to open up, countries are opening up, and business will pick up in the next couple of weeks. We've seen the UK system open up during the week, so there's been a lot of easings with in different countries, in many countries, and as the easing of the lockdown continues, we'll begin to see interest in Nigeria, and of course confidence from investors to come into the country, and liquidity level would definitely improve. So last week alone, I think total turnover at the market was about $150 million. And so far this week, market volume has been over $270 million. So we can all see that is improvement, and, we hope for better days to come.
So we also know that there are some loans that the federal government is taking from the World Bank and some other multilateral institutions. By the time those FX inflows come in, how much of improvement will that bring to this I&E window and possibly the FX space at large? Well,
by the time we see all these flows in the market, we expect that there will be some level of appreciation in the market, because we've had a global situation which was not peculiar to just Nigeria, and it's been a global issue, and everybody is looking at jump-starting and kicking off their economy. So based on the fact that we've had backlog of demand in the market, when all this money is coming, when business improves, and then they're able to channel these funds to the right projects, then we would see the back and forth, and then the increase in market liquidity going forward.
Right. Adekemi Adenugba, FX trader with FSDH Merchant Bank. Thank you so much for sharing your thoughts with us on the program this morning. We appreciate it. Thank you so much.
Okay.
Right, Bissy, back to you.
All right, Temple, it's good to see you back. And of course, we hope for a profitable trading day.
Sure, we will.
And that's where we end today's show. Thank you for watching. I am Bisi Adebayo.